Alright, welcome to the CFO channel. My name is Ali and I simplify accounting and finance concepts. In this video, we're going to cover what the term CFO means. This is called the CFO channel, but what does the term CFO mean? What is the role of a CFO in a company? CFO stands for Chief Financial Officer. If you look at the leadership team of any major company that is publicly traded, I can guarantee you that there is someone on the executive team that holds the title of CFO. Here's a quick snapshot of Microsoft's leadership team, and you can see that the CFO is a woman named Amy Hood. If we look at another company, let's take a look at Bank of America. The CFO is a guy named Alistair. I hope I'm pronouncing his name right. So clearly anyone in an organization that holds the CFO title is quite important. But what is it that they do exactly? At a very broad level, the CFO is responsible for all of the financial activities in a company. What are some of these financial activities? You could break them down into 4 categories. Number 1, financial reporting. Number 2, forecasting and planning. Number 3, strategic guidance. And number 4, capital allocation. In this video, we'll cover all of these 4 major categories that fall under the CFO's purview. The CFO has the ultimate responsibility to prepare a company's financial reports. These include the profit and loss statement, the balance sheet, and the cash flow statement. If you'd like to understand what each of these financial statements mean, check out my previous video here where I cover the basics of financial statements. Basically, if anyone in an organization asks a financial question, which could include, what was our profit? How much cash do we have? Can we borrow money? The person that would have the information to answer all of these questions is the CFO. When it comes to public companies, the CFO also has the responsibility to make sure that the company files its 10Q, so its quarterly financial reports, and its 10K, its annual financial report. These are SEC requirements that all companies must abide by if they are listed on a public stock exchange. One of my personal favorite finance functions is forecasting and planning. This function is responsible to develop a budget and a financial forecast for the company. Usually when the CEO has to make a major strategic decision that involves a financial cost or has financial implication, the CEO will usually ask the CFO to prepare a report or an analysis that would detail the financial consequences of the big decision that he or she is trying to make. These strategic decisions are many, but they could include things like, number 1, launching a new product, number 2, increasing prices on a company's products, or number 3, the decision to buy a competitor, usually referred to as M&A or mergers and acquisitions. Let's look at a concrete example of what this would look like in a real-life situation. In 2022, Microsoft announced they would buy the game maker Activision Blizzard for $69 billion. Usually, a decision like this isn't made on a whim. Microsoft's CEO doesn't just wake up one morning and say, hey, I'd like to buy Activision Blizzard. No, that's not how it works. The idea to buy Activision Blizzard could have come from one of the company's senior managers or the CEO himself. But once someone has the idea to buy a particular company, that's where all of the hard work begins for the CFO. What work does the CFO need to do? The CFO needs to complete a forecast and some analysis that would show the CEO the following points. Number 1, how the company can pay for the acquisition. Number 2, whether or not the acquisition will either help or hurt the growth of the company. And number 3, whether or not the company is able to get synergies through cost savings by buying out a particular competitor. All of the financial consequences of a major strategic decision need to be answered by the CFO. Once the CFO is able to make the case that the acquisition or that particular strategic decision makes sense from a financial perspective, the CEO can begin to engage other stakeholders in the company, like the lawyers, other departments like engineering and product, and then slowly start to approach the particular target about a potential acquisition offer. Before a formal offer is made for an acquisition, the CEO generally has to take that particular idea, all of the financial analysis that has been prepared by the CFO, take all of those documents to the company's board in order for the board to be convinced and to approve the acquisition, after which the CEO can formally take the company's bid onto a competitor or whichever target it is that they're trying to acquire. In the case of Microsoft, the CEO would have to take all of the financial analysis that has been prepared by the CFO and take that particular analysis to the board to make sure that the company gets board approval. And then once the board has approved the acquisition, that approval is taken and presented formally to Activision Blizzard in this case. Now, closely related to the points that we covered in financial planning and forecasting is this concept of offering strategic guidance. I used to think that the term strategic guidance was a very fluffy term that didn't really mean anything. But as I've become more experienced, I've learned that a CFO that can offer strategic guidance to a company is really valuable. You see, when it comes to accounting and finance, you can look at your numbers in two ways. Number one, you can look at historical numbers. These are your historical results, which are quite interesting to you and quite informative. However, the past can't be changed. The second thing that you can do with your numbers is to begin to look forward and start to plan out and understand what your company is going to look like in the next 6 months, in the next year, or in the next 3 years. A good strategic CFO is able to help a company look forward. He or she can help an organization understand and carve out a path on how it could achieve its particular goals and objectives and understand how and where it needs to go. For example, let's say you're the owner of a business that today does $1 million in revenue per year. You'd like to grow this business to be $3 million in annual revenue, but you're unsure about what it takes and how to get there. A good CFO will help you take that goal and then deconstruct it into annual, quarterly, and monthly targets to make sure that you're on pace to hit your financial objectives for the year, such that you eventually build your $1 million business to a $3 million business. The CFO's plan will usually include things like how many clients you need to get every year to hit that particular goal, how much product you need to sell, what your pricing needs to be, when you will need to hire different employees or contractors in your business, etc., etc. In a nutshell, a really good CFO is able to help you set the strategic direction of where your organization is going to go. Capital allocation is really a fancy word that basically means how to allocate money. The CFO usually has the ultimate responsibility to come up with a plan of how an organization or a company will spend its money. Now, this money can come from a number of ways. Number one, it could be internally generated from the operations of a particular company. Number two, it could be money that is raised in the public market. So this is when a company is going public through an IPO. Or number three, it could be money that a company has raised by getting a loan from a bank, so raising debt. When it comes to capital allocation, the CFO generally has two main responsibilities. Number one, he or she needs to figure out how to allocate this money to grow the business, or number two is to figure out how to take this money and return it to its shareholders or its owners. When you're thinking about using money to grow a particular company, generally there are two ways that you can do this. Number one, you can invest it internally. So the CFO can essentially take this money and give it to whomever in the organization to spend it on marketing or to spend it on research and development and come up with new products that the company could eventually sell. Or number two, it could also take that money and help the business grow by buying a particular competitor. This is usually referred to as growth through acquisitions or mergers and acquisitions, or M&A for short. On the other hand, when a CFO is thinking about returning money to shareholders, usually this is also done in two ways. Number one, the CFO and the organization, the company, could declare a dividend to its shareholders, to its owners. Or the second option is to generally return money to shareholders by buying back shares. This reduces the number of shares outstanding in the market and generally increases the value of the shares that remain outstanding. Just a quick note, usually in smaller organizations, the CFO's role is usually a bit more dynamic. The CFO generally assumes other responsibilities, including all of the financial activities, but he or she could also assume roles such as HR, handling IT, and other admin functions in the business. So I hope this video helped you understand what a CFO does in a particular company. If you like this video, give it a thumbs up and check out my previous video here where I talk about the basics of accrual accounting. See you in the next one.